In July 2000, Nortel Networks was valued at over $350 billion. By 2002, it was worth less than a dollar. This is the story of how Canada's tech giant fell from grace. Nortel Networks, once the pride of Canada, was a telecommunications powerhouse. Founded in 1895 as Northern Electric and Manufacturing, the company initially produced telephone equipment. Over the decades, it grew into a symbol of Canadian innovation and technological prowess. By the 1990s, Nortel was not just surviving, but thriving, having embraced the digital revolution with open arms. In 1998, it rebranded as Nortel Networks and acquired Bay Networks for $9.1 billion, marking its aggressive expansion into the Internet age. This acquisition was part of CEO John Roth's vision to transform Nortel into the leader of the Internet revolution. The company rode the wave of the dot-com boom, seeing its market value skyrocket to unimaginable heights. But beneath the surface, cracks were forming, waiting for the right moment to fracture the once mighty giant. As the new millennium dawned, Nortel was at its zenith. The company was on fire, boasting cutting-edge advancements in fiber optic technology, which was then seen as the future of global communications. CEO John Roth was lauded for his aggressive expansion strategy, which seemed to pay off as Nortel's stock soared. However, his focus on stock prices over sustainable growth sowed the seeds of disaster. The tech industry was volatile, and Roth's gamble on rapid expansion without a solid foundation of sustainable practices would soon prove to be a fatal flaw. In 2001, as the dot-com bubble burst, Nortel's stock plummeted from $120 to $8 almost overnight, wiping out billions in market value. Panic ensued as investors and employees watched in horror as their dreams crumbled. The leadership under Frank Dunn, who took over as CEO in late 2001, and CFO Douglas Beatty faced mounting pressure to stabilize the sinking ship. In a desperate attempt to keep the stock afloat, they resorted to aggressive accounting practices, which involved manipulating financial statements to inflate profits and meet Wall Street's expectations. These practices masked the company's declining profits, creating an illusion of stability. But the truth couldn't be concealed forever. A series of internal audits and external investigations revealed the depth of the deception. November 10, 2008, marked a turning point. Nortel announced 1,300 layoffs alongside a staggering $3.4 billion quarterly loss, sending shockwaves through the industry. The writing was on the wall. Just 2 months later, on January 14, 2009, Nortel filed for bankruptcy protection, citing a debt of $4.5 billion. The largest corporate collapse in Canadian history was underway, affecting shareholders, pensioners, and employees alike. The once mighty giant was brought to its knees, leaving a trail of devastation in its wake. The human cost of Nortel's downfall was devastating. Over 30,000 jobs were lost globally, with thousands of employees in Canada left searching for work in a market that had little to offer. For many, Nortel was not just a job, but a career, a part of their identity. Pensioners saw their retirement benefits slashed, forcing them to alter their plans and face financial insecurity in their golden years. Shareholders were left with nothing as billions in investments evaporated, leaving many questioning the integrity of corporate governance. The ripple effect shattered Canada's tech industry and economy, leading to a profound loss of trust in corporate governance and a chilling effect on investment in Canadian tech companies. The root cause of Nortel's collapse lay in its failure to adapt to changing market dynamics and technological advancements. The leadership's obsession with short-term gains led to a culture of mismanagement and ethical compromise. Nortel's aggressive expansion during the dot-com boom prioritized rapid growth over operational integrity and innovation. The company's inability to anticipate and adapt to the rapid changes in the telecom industry, coupled with a toxic corporate culture that valued profits over people, sealed its fate. The trial of Frank Dunn and Douglas Beatty began on January 16, 2012, in a Toronto courtroom. They were accused of accounting fraud, a testament to the toxic corporate culture that had developed under their watch. The trial was a stark reminder of the consequences of unchecked corporate ambition and the ethical lapses that can ensue when integrity is sacrificed for profit. Though both Dunn and Beatty were eventually acquitted due to insufficient evidence, the trial highlighted the need for stronger corporate governance and transparency. Nortel's story is a cautionary tale. It serves as a grim reminder of the importance of corporate integrity and adaptability in an ever-evolving market. The legacy of its rise and fall continues to resonate within Canada's corporate landscape. The lesson is clear: sustainable growth and ethical governance are paramount in business. Nortel's collapse broke Canada, but it also taught invaluable lessons about the perils of prioritizing short-term gains over long-term sustainability. The scars left by Nortel's downfall are still visible today, but they serve as a reminder of what can happen when ambition blinds responsibility.